Joining me today on NYSE Floor Talk is David Jegen. He is the managing partner at F-Prime Capital. David, it's wonderful to have you here. Thanks for joining me.
Thank you for having me.
So let's start off by talking about F-Prime Capital. Tell me about it and tell me about your fintech focus.
Sure. So F-Prime Capital has been investing for over 50 years in early stage technology and healthcare startups. I would say fintech has been our first love. So we've been investing in companies for a long time, including old companies like Alibaba, Zoom, Archipelago, which actually was eventually acquired by NYSE, and more recent companies like Toast, Flywire, Plaid, as good, Vestwell as great fintech examples. So we, I would say fintech has been an area that has changed profoundly over the last 10 years in both depth and breadth. So it used to be a $1 billion category of venture capital per year, and now it's almost 30 billion per year. It used to be selling tech to brokerages and exchanges and banks, and now it is startups that are actually building brokerages, exchanges, and banks. So along with that, fintech has grown in surface area for F-Prime Capital and become a really important piece of what we invest in an area we love. It's almost half of our investments.
So tell me about the F-Prime Fintech Index, and why did you start tracking this group of fintech startups that have gone public?
Yeah, so we started the F-Prime Fintech Index 3 years ago because there were finally enough startups, fintech startups, public to track. So we had almost 77 IPOs in a 24-month window. And for years before, we had often talked about, could we build something that would track disruptors? But we finally had enough to do that. And we thought it would be a great way not to create a basket of stocks that people would invest in, but rather a way for investors and other people in the industry to see how are companies performing and what impact are they having in financial services. So we track that index. We also have a companion report, a state of fintech report that we just launched last month, as well as a set of operating and financial metrics that we maintain on a website. So investors can go in and look by sector and see how are lending companies, how are capital markets or payments companies performing, and really get behind the headline valuation numbers.
Now, tell me, what matters to public investors in fintech companies right now?
Well, it is easier to answer that question from 3 years ago, when I'd say it was definitely growth and multiples, valuation multiples were sometimes 20 times revenue. But as interest rates rose and there was a correction in the market, investors have shifted. And I would say investors are more focused on two things. One would be capital efficient growth. And we even saw that in the FinTech Index, and that at times last year, high growth, faster growing fintech startups had a lower valuation multiple than slower growing ones, but investors were looking for that Goldilocks balance of capital efficiency and growth. But and that's maybe, I could say, true of all tech stocks, but in fintech, the specific second change was the way investors started to reappraise whether a fintech company is really a tech company or actually a financial services company, maybe a newer one, a better one, but one that would be subject to the same laws of financial services. So I would say lending, banking, insurtech, those would be categories where I think public investors said those look a lot more like a typical bank or brokerage, and therefore they were revalued in that way.
Go ahead.
Well, and then maybe to answer specifically right now, I think gross margin has become the metric that public investors are really focused on across fintech, because it's a unifying metric that takes into account that payments companies and prop tech companies make money in very different ways. But gross margin is a common structural measure of profitability, so I see a tighter correlation to that than I have in past years.
Now tell me, what new developments are you seeing in fintech regulation?
That's a good question. This last year was definitely the year of regulation on and risk off. And we have had a 10-year run of fintech innovation. And I think regulators have been tracking it, but finally turned up the scrutiny and the questioning of how should these new startups be regulated. And I think that's appropriate in some ways. Like in every cycle, innovation tends to outpace regulation, but it lags it, but eventually tracks it, determines the guardrails, and starts to write regs. So we're seeing a lot of that, literally across the board of every sector, probably falling into three categories. One is regulators are writing new regulation for de facto innovation, and crypto would be a good example, where outside the US at least, many jurisdictions have written new regulations and frameworks to permit, authorize, and then regulate crypto exchanges. That's less the case in the US, where it's been more regulation by litigation, but over time that will change. A second area has been kind of forcing fintech innovations into existing regulatory frameworks. And that is like lending, buy now, pay later, early wage access would be examples where a regulator might say if it walks, talks, quacks like a duck, then we should regulate it like a duck. And they are trying to, state by state and or federally, put those in traditional frameworks. And then the final one, we're seeing quite a bit, especially with the Discover Capital One announced merger. We're seeing a lot of talk around interchange, both before that and now we will see more after that. But Federal Reserve has the power to regulate debit card interchange, and they are re-looking at the Durbin Amendment and asking whether they should further lower the cap on debit. And for the first time in a long time, we see a Senate discussion around a new credit card competition act, where they're looking at whether to cap credit card interchange. So a really interesting time there.
Mm-hmm. And finally, David, tell me, what fintech trends are you tracking for 2024?
So we've got some great ones. I think that in some ways it's never been a better time to invest in fintech, because we've had 10 years of startups building tools in the front office, the middle office, the back office. So it's easier than ever to build a fintech startup or embed fintech in your company. I'll name one. One is around private markets themselves and alternatives like venture capital, private equity, private credit. I mean, we always are looking for sectors that have not yet fully digitized or automated, and alternatives is changing dramatically. And players like Blackstone would be a good example. KKR, they have gone after the retail investor in a tremendous way. I think Blackstone has almost 25% of their $1 trillion of assets coming from retail investors, and it used to be zero. It used to be just institutions. But as they are expanding the number of limited partners from hundreds to thousands, and new players like Franklin Templeton are entering the market with private funds, the number of investors, the number of transactions and documents are going from hundreds to millions. And that requires a new tech stack to digitize that, and it's a great place for startups to be investing.
All right, well, David, wonderful to talk with you.
Yep.
Thanks for joining me on Floor Talk.
Thank you so much, that was great.